Hi, my name is Michael Higgins and I'm the Portfolio Manager for the Milford Dynamic Small Companies Fund, and I'm really excited to be part of the virtual Morningstar Conference for 2025. I've been at Milford for around 8 years now, and with a background coming from Macquarie and then prior to that as a structural engineer. The Dynamic strategy was established in 2013 but only available for Australian investors since around 2019. So we've got around 6 years of performance domestically. This is Milford's style-agnostic, stock-picking strategy. We don't want to come to our investors in 6 months' time and say, oh, look, sorry, we're a value manager. Growth really rallied in the last 6 months. Sorry about that. Being an all-weather manager is really important to us. We have a proven track record over a sustained period, generating over 5% alpha over around that 12-year period since inception. Like other managers in small cap land, we're benchmarked to the small ordinaries. It's not overly unusual, but there are some levers that we have to our advantage that makes us a little bit different. Firstly, we can invest in ASX, between the ASX 20 and the ASX 100 in that mid-cap land. It's really important area for us to invest in, that not only can we put on risk very quickly, we can also take it off quite quickly in areas of concern. We can invest in NZ equities. This is really valuable for us when we have a team of 5 in New Zealand. We can really cherry pick their best ideas within this particular strategy. And then finally, we can at times have up to 20% of cash in the portfolio. Now, I always do tend to point investors towards 90 to 95% invested as reasonable levels to expect over the longer term, but there are times when we will look to increase cash to protect investor capital. At Milford, we're not out there running big institutional mandates. We don't have to be 98% invested in this strategy. What's really important to us, what's important to me as an investor, our team that are investors too, is that we can protect capital at times of concern. Now, the agenda that I wanted to talk to you today were why we like playing outside of the ASX 20. I wanted to touch on some of those characteristics outside of that X20 and why they're important. I wanted to talk to you about Milford's approach in terms of combining not only a top-down view, but very much that bottom-up approach. I wanted to touch on the recent underperformance of small companies, and then I wanted to really touch on a couple of observations that we're seeing not only in the domestic market, but also internationally in those volatile global markets. And then finally, I'll touch on some of our more recent performance. Now, first of all, why play outside of the ASX 20? I mean, Australia's large cap market indexes are really narrow and they do lack diversity. While you've got the Magnificent Seven in the US and they're constituting around, over 30% of the S&P 500, by comparison, in Australia, our 4 banks and 3 mining companies represent around 35% of the ASX 200. The reality is bank earnings peaked in around 2017, and with NIM compression, there is going to be very little growth in 2025. But when you look a little bit deeper, for every $1 that you're investing in the ASX 100 today, around 54 cents of that goes into banks and conglomerate miners. Like I said, not a great diversification of your earnings or an optimal use of capital. So how can investors think differently and take advantage of ideas outside of the top 20? Well, the answer is small to mid-cap investors, something the Dynamic Fund has actually been delivering for over 12 years. Now, what are the characteristics of the X20? The X20 currently is forecast to grow around 5 to 7% over the next 12 months. They tend to offer exposure to higher growth businesses, maybe future-facing commodities exposed to structural changes like decarbonisation as an example. There's a few monopoly technology businesses thrown in there like car sales and realestate.com. But small to mid are an area where you can gain access to really great companies and they're far less discovered. They're not covered by 50 different analysts covering BHP and Rio as an example. And importantly, it provides a greater exposure to founder-led businesses. While this is a topical point, given some recent high-profile indiscretions here in Australia of late, but what we've found in the Dynamic Fund is it's been a really fertile ground for us to generate strong returns. And we put it down to 3 things as a team. First of all, we put it down to that long-term mindset. Second of all, skin in the game. And then thirdly, one of the areas that's hard to characterize, but it's that soul in the game, that real passion for your business. And Essentially, why do we think they outperform over time? It's founders that they're looking to establish the business in a multi-generational timescale. They don't care about short-term incentive plans set up by an independent board. They're looking to build a legacy, which requires really long-term thinking. That most underestimated attribute that we find is that broader love of the business. And for many advisors out there that I speak to, and I'm sure that are listening today, I'm sure you can attest to that too, given a lot of you run your own businesses. Further on the theme of small to mid caps and why we think they're interesting is just that there's been a significant underperformance of the small industrials index versus the large caps, and it's really at close to extreme levels at the moment. And this chart looks at that rolling performance of the all ords versus the small ords. We've seen great crowding into banks within that large cap universe. And we've also seen offshore investors looking to get leverage to one of the cleanest, dirtiest shirts globally, which is, the large cap Australia market, in a time when there have been parts of Asia that have been in pretty weak markets to being in bear markets. We've also seen more recently a really greater influence of mandate moves, of institutional mandate moves across large cap universe, of a lot moving from active to passive. And that shift from active to passive really does influence that large cap market and has far less influence on small cap. So it really does provide opportunities within small caps for that mean reversion that we're really excited about here at Milford. Now, what's important to take advantage of that is actually having a really repeatable process and being really nimble. Now, over time, our top-down approach and bottom-up process we found outperforms in both up markets and down markets, and the current chart really is a good description of our process. Now, on the left-hand side of the chart is very much our top-down view, where we assess, profits, policy, positioning, price, and potential risks. It provides provides a guide for us to how we want to be managing risk. It's an important tool in the toolkit. If the macro is favourable and data points are evolving, we will look to size more aggressively in our position sizing. Yet there are times when the market is euphoric. Maybe it's a bit of time to be a little bit more defensive. It's all about finding that balance, and that having a top-down view is a really important way. It also assists in some idea generation. Are we early cycle? Are we late cycle? Are we entering an inflationary environment? Or, as an example, where do we expect interest rates to go, and how does that affect some of our more defensive exposures? So it does, like I said, provide a guide to how we approach investing. But what's really important with the Dynamic Small Companies Fund is what's on the right-hand side of this chart. It's really that grunt work, the bottom-up research that we're doing. It's really critical, that fundamental research, getting out down the road, meeting management, heading offshore, tracking down competitors on LinkedIn or other areas you might find. And it's also important to have a really good sense of valuation. And that process, or that fundamental process, is really listed quite nicely here, where we assess management, industry, company, financial, valuation, and ESG. The way I view this particular fund is it's an 80% sort of stock picking fund, but we do have that influence from the top-down view on the left-hand side, which, like I said, can offer us guidance at times of how much risk we want to take and our position sizing. Now, we are style agnostic investors here at Milford, and like I said, we are all-weather investors, and that essentially means that we invest across the spectrum. We are not a value manager, we're not a growth manager. We are agnostic. We have 5 categories that control risk and diversify our portfolio, and they're listed here in the chart. We've got income stocks, quality stocks, growth, cyclicals, deep value turnarounds. It does tend to be pretty slim in small cap investing, and then finally the cash proportion. Now, historically, we've had a really heavy allocation towards growth and quality, and this is even prior to 2019, where this chart shows, which is not surprising with an economic backdrop of that lower interest rate period that we went through. But what's important about small companies is actually it is finding some of those growth companies. It's finding those companies that are proving out their business model, that haven't had the time yet or the capital to fully penetrate their addressable market. They're really some of those companies that we're trying to find. But there are times in the last couple of years where we've wanted allocations to other areas, and there's also times where some of these sector allocations become quite frothy. Now, This chart I really like because it points to I like to point to a couple of points in time which really provide a really good clear differentiator of the dynamic fund and the ability to invest across the spectrum versus some of our peers. Now first, what happened in that October 2020 period as an example for us to become far more optimistic, to add far more cyclical stocks in the portfolio. Well, we got a vaccine in that October 2020 period. I mean, prior to that, we were trying for a COVID zero approach, which indeed would have resulted in a very drawn-out recovery. And that vaccine really opened up the economy, favouring cyclicals and that reflation trades, finding companies that would do really well in an inflationary environment. So we're really pleased to generate significant alpha over that period of time. And then over in that late 2021 period of time, it was probably our lowest allocation to technology we've ever had in this portfolio, going back over 12 years. And what happened in that period of time? We had this incredible amount of froth around that 2021 period in growth companies, which did come back down to earth. And now more recently, how are we allocated? We're very deliberately diversified across our 5 key categories we like to monitor. We like to be balanced in this environment. Yes, we own some exciting growth companies within our growth bucket, like a Life 360. We have really quality compounding companies like a Regis Healthcare in there. We've also been playing quite a bit of New Zealand allocations within our income bucket. They're obviously far more advanced in their rate cutting cycle than we are here in Australia, and so that's been quite a positive dynamic for this particular fund. And also within that cyclical bucket, we've also had a higher proportion of gold companies in that cyclical bucket. And this is actually becoming an increasingly a differentiator of this strategy across other small cap strategies out there. For many, many years, you haven't really had to worry about resources or gold. They've been quite poor performers in that period of time. I went back and checked the small ordinaries back in May 2018, so a number of years ago, and gold only constituted around 5% of the small ordinaries index. We're now sitting at close to 16%, and when I checked midway through last month, we hit 20% of gold allocations within that small ordinaries benchmark. So it really means that you need to be cognizant of how you're investing in small caps to ensure that the manager that you're invested in invests across the spectrum. It's a really important dynamic, and I'll touch a little bit later on in terms of some gold slides, which you might find interesting. Now, let's keep moving and touch on some of the domestic macro environment here in Australia, where I pulled out some really interesting charts. Now, the first chart I've pulled out is a chart that CBA put out every quarter, which really looks at the debit and credit card spending across age cohorts. Now, on an aggregate level in Australia, the economy is actually quite robust. We have really strong fiscal stimulus from both state and federal governments. We've had rate cuts. We've had a rate cut with a 97% chance of another one next week, and this is post this recording, so we'll see how that plays out. We had a tax cut last year, equating to a couple of rate cuts equivalent. We've had energy rebates in Queensland. We've had lower fuel prices that are beginning to come through the economy, worth, again, probably a number of rate cuts equivalent on our consumption patterns. But interestingly, the divide between the asset-rich older demographic versus the younger demographic is really stark, and this chart really shows that story nicely. Spending is really uneven. You can see across that older demographic that discretionary spend is elevated, north of 4.5%, across that over the age of 45. And you can see, interestingly, that 65 plus, I mean, they have the largest discretionary spend across every age demographic. What's also really fascinating is that they also have the highest savings rate. So this demographic is not only, they're doing incredibly well at the moment, they may have an investment property where they're getting rental increases, they're quite long assets, they don't have much debt, they're probably getting some higher interest rate revenue on their cash, and they're travelling more, they're spending more on their discretionary spend, while those in the age groups of below 25 and below 35, which is either in that rental belt or that first home buyer belt, is actually really beginning to or have been struggling in their discretionary spend. You can see them eating into their savings in these last couple of quarters. But it is a really interesting bifurcation of the consumer that we're interested in. This is a dynamic that we speak about a lot as our team in determining where we want to be looking for our ideas, and we essentially want to be allocating towards sectors that may be more beneficiaries of some of this dynamic we're seeing. Now, the other chart that I wanted to talk about in some of the areas that we're monitoring is this Australian government spend. Now, what's listed on the chart is the government demand as a percentage of GDP. We've never really been at higher levels, not only from a federal level, but also from a state level. And you can see this going back in time to 1959. Now, this is a theme that we've seen across the world. We've seen huge increases in fiscal spending by many countries around the world. COVID really broke open those fiscal barriers. And it was essential spend at the time to keep economies and people afloat. But once those barriers came down, they have not really come back up. And the most notable region for this is actually in the US. Since the founding of the US in 19, there's only been a real handful of instances where they've run deficits north of 6 to 6.5%. We've got the Civil War, we've got World War I, World War II, the GFC, COVID. These are all some pretty big events. We didn't even get there in the Cold War or the Vietnam War, but we are there today in terms of those deficits, and we have been for the last couple of years. So in Australia, we're not as extreme as the US, but we are definitely seeing a huge amount of government investment, which is crowding out private investment. And interestingly, we've just had an election. While it was an election of small ideas, no doubt, what I'm sure we would all agree on is that there was a significant amount of handouts, tax cuts, fuel rebates, potential fuel rebates, and this is after we got tax cuts last year. This is not to mention the 20% cut in student loan debt. And if you're in Queensland this year, you're probably paying nothing for your power. You've got not only a federal grant, but also a state grant. So money is really pumping around the economy, which is a really interesting dynamic in Australia. And the government more recently has been a key driver of employment. You can see some of the early data is indicating that around 2/3 of all jobs created in the last couple of years across Australia were really publicly dominated, whether it was the NDIS or all government spend in general. It's an interesting dynamic. No doubt an area like the NDIS is doing a lot of good for the economy in terms of helping a lot of families with might have kids with disabilities, but the reality is it is growing very quickly, and if it continues to grow at the same track record that it is now for the next couple of years, it's going to hit close to the age pension in size by around 2030. So it's something that we really need to monitor. And when you think about more broadly, to think that 12% of all boys in Australia are on the NDIS and 6% of all girls are on the NDIS with a skew to elite private schools, clearly there needs to be some guardrails put around this particular system to ensure it's not getting too far out of control. Now, another area that we're monitoring is valuations, and this chart that is released by Matt Brooks, who is a Macquarie strategist who we rate highly. They put this out 2 weeks ago. It really looks at the valuations in Australia. We're at close to 90th percentiles of history, and this is largely driven from that immense re-rating of banks that we've seen, where we've had very little EPS growth and a significant amount of PE re-rating. And it's worth being aware that there are some areas of the market at the moment that are quite stretched, and this chart is a good reminder of stock moves when US slows down or are in recessions, which are the black bars on the lower areas of this particular chart of US recessions. And you can see the share price move. So while this is not a red flag per se, it's certainly an amber flag. I mean, while valuation is certainly informative around longer term returns, interestingly enough, it is actually not that useful as a short-term indicator for market returns. So it's worth keeping that in mind. Now, I wanted to touch on now what we're monitoring on a global sense. And like I said, we are a small cap manager, but we do have a top-down influence in the way that we invest. So we do need to monitor what's happening globally. Now, the biggest area that we're monitoring global is Donald Trump. Look, he won with a landslide. He won with a mandate to change, no doubt. We're expecting tax cuts. We're expecting deregulation. But first we need to get through tariffs. which are arguably negative for growth in the near term, but could be highly inflationary. It's like every morning I'm waking up at the moment. It's like the season finale of The Apprentice. You never know what's going to happen. And I don't pretend to tell you now exactly what's going to happen because I don't know what's going to happen, let alone next week or tomorrow morning. It is a moving feast. But what I do know is now is the time to ensure that diversification is at the top of the list of the way that you're investing. This is coming from a period where the less diversified you've been, the better you've done, interestingly enough. Think about the Mag 7, think about NVIDIA, or even better yet, a 3 times leveraged NVIDIA where there are some that some people are in out there. I think we're going to see a time where value of diversification is potentially going to be making a comeback. Because the one thing I know is that global capital goes to where it's treated best. And right now, many US policies look like America-only policy as opposed to America-first policy, so that's worth keeping in mind. Now, an area that we're monitoring is retail participation in equity markets. Now, pictured that you can see is the monthly net new accounts open for Interactive Brokers, which is a retail platform. And this looking back to January 18, so around that 7-year period. Now, we're close to all-time highs with retail participation, a key driver of US stocks, really since the AI boom last year, if you think about it. We're back to the nosebleed levels of 2021, and as a reminder for those with sort of short memories, back then we still had negative real yields. ARK was trading at north of $120, and SPACs was still a thing, albeit they were probably a deflating thing at the time. But this snapshot was from February in terms of those account openings, and when you think about the prior 2 years from February, the Nasdaq delivered a 68% absolute return over that period of time, and the S&P 500 delivered a 50% absolute return over the prior 2-year period as well. So while this is the retail participation is not necessarily a red flag again, it's certainly an amber flag, an area that we're watching as a potential vulnerability. I said I'll touch on gold a little bit, and I will now. I came across this chart from the World Gold Council, and while I'd seen it before, it was a really good reminder to remind me of those key drivers of gold and what have been the key drivers to gold in that last 10-year period. You can all see that the gold demand line, which is that golden line, and it captures the recent gold price on the right-hand side of the chart. Now, obviously, the key historical drivers are largely in that purple, and you can see the consistency of the purple over time. And that's been the jewelry fabrication. In the light green, you can see the total gold bar and coin manufacturing, which has been largely consistent over that period of time as well. So that's not overly unusual. But you can see the rapid expansion of that dark green bar happening around that mid-22 period. Now, that dark green bar is all about central bank net purchases of gold. Now, going back to 2022, what happened around this time to potentially change this from a geopolitical sense? Well, this is when Russia invaded Ukraine and subsequently had their reserves held in the US frozen. Now, what did every other country do in response? Well, they reassessed their allocation to areas like gold as an alternative asset to be held onshore. And this buying has largely continued, as you can see by that expanded green chart. Now, this is an interesting dynamic, but one of the other interesting gold drivers has been actual retail participation, which is beginning to show. Now, this chart is a proxy for the we think about retail demand. It pulls out the SPDR gold ETF in the US, which is you can see the gold price and how it's gone parabolic. And you can see in the blue line, it really looks at the shares on issue. So this really shows that how in demand this ETF is. If a lot of people are out there buying, then there's going to be more issued shares within this ETF. And it's only really starting to pick up now. And this is really the only period of time that I can recall where not only do we have the West beginning to buy gold and have been buying gold, but we've had the East and China, the central banks buying gold too. So that combination we think is reasonably powerful. But the thing you need to remember with gold and actually investing in all commodities is there are risks involved. You can never fall in love with a commodity. But right now we do feel like the setup is very different on gold at the moment, and it's something that we're monitoring and do hold gold within the portfolio. Now, let's touch on the current strategy. in terms of how we're investing the Dynamic Small Companies Fund. Now, we think at the moment we're in incrementally more difficult markets. Look, we don't think it's all going to hell, but incrementally more difficult, which requires us to be incrementally more disciplined in how we think about risk assets and how we think about future winners. We think diversification is going to be increasingly important. We also think valuation will become increasingly important. Now, I've pulled out some of these 6 different categories of what we're thinking about. The first is we need to be highly selective in consumer discretionary. I touched on that bifurcated consumer earlier. It's certainly something that we're thinking about. There's a lot of cost of living pressures in certain cohorts, but there's also a cohort of people that older demographic that's very much spending at the moment from a discretionary sense, and also living life, which we haven't quite seen in the last couple of years. The second component is looking at quality compounders. It's hard to ignore some of these growth stocks when searching for high quality earnings compounders, and we don't shy away from that. We're thinking about the commodity complex. Obviously, gold, I've touched on, is something that we're thinking about and having exposure within the portfolio, albeit we do feel like we are at technically overbought levels. We're also thinking about and have a preference for areas like East Coast gas and the Australian gas market, where we think there are going to be some supply and demand imbalances getting established over the next couple of years that can only really mean higher gas prices. So we're thinking about getting exposure within the portfolio to get leverage on that. And then policy beneficiaries, no doubt, onshoring in the US, whether it's something like a Blue Scope that has facilities in the US in steel manufacturing and to invest in that deglobalization effort. We're thinking about multi-year growth opportunities within the portfolio, whether it's aged care reform, which has been an area you haven't really wanted to touch in the last 10 to 15 years, but bipartisan support in the last really 12 months has meant that this sector is actually really well placed to generate some really interesting returns going forward. And so companies we're thinking about in that space are something like a Regis Healthcare. We're thinking about the resi building deregulation that's going on. Clearly, migration is a key part to our current government's growth ambitions, and that will require further resi development. So we're certainly thinking within the portfolio sense of how we can get leverage to that. And then finally, we're really prepared to change view and be highly diversified across growth and a balance of defensive sectors. Now is not the time to be all in one sector. We really feel like it's a time to be diversified and be with a highly active manager that can take advantage of that. Finally, just quickly on our performance, what we like to be here in this particular fund is we want to be consistently reliable rather than occasionally extraordinary. We're really proud of these numbers and the consistency of the strategy and how it's performed going back over 10 years, over 12 years now. We clearly have a repeatable process to deliver 5% alpha after fees over that 10-year period on a per annum basis. And this has been really during really tricky markets as well, which we're really pleased with. What's also quite important to Milford is actually being able to generate really good risk-adjusted returns too. It's not all about being very long growth or very long value. It's about having diversification and managing our risk-adjusted returns well. We're in the quadrant that we want to be in, that top left-hand quadrant, where we're able to deliver really good returns consistently, and not only beat our small ordinaries benchmark, as you can see there, but also our peer group median. So we're, like I said, we're in that quadrant that we want to be in and perform. Now, that's all from me. I'll wrap up there. I really thank you for listening in today on the presentation. If you do want any more information around the strategy or around Milford as a fund manager, please do get in touch. We'll be happy to hear from you. Thanks for your time.